Back in the former Soviet Union, there was this cat named Pavlov, and he conditioned his dogs. They would give him, they'd salivate and he'd give them a treat. So came up with these things called Pavlov's dogs. Dan's like, okay, what are you doing?
Where are we going?
The reason I mention it, because I hear this music now and I like salivate. Like that little guitar riff gets me going. It is 1 p.m. Eastern time on the East Coast. It's Wednesday, the 11th of January. Guy Adami here. That's Dan Nathan, of course. In a minute or so, Carter Worth of Worth Charting will be joining us. Today, we're sponsored by FactSet, Dan, financial data and analytics that are powered by tomorrow. And, of course, they're our data provider as well. I like saying the word data. Great win, gritty win last night by the New York Rangers at home against the Wild of Minnesota. Went down 2-0 early. Although I thought the Rangers were outplaying Minnesota, I felt good. One of the most dangerous leads in hockey is, in fact, a 2-0 lead. They came back and won it in overtime, as you know. I know you were excited. How are you?
I'm doing well, Guy. And I think you did that because somebody in our comments said, keep leaving the comments, people, because someone got you all tuned up yesterday because they did not care to hear about your little take on the New York Giants. And that's just the way Guy Adami operates. Guy, are you wearing a ring? Wait, are you wearing a ring?
Well, yeah, I wear a ring every day.
Oh, I thought it was something else. I'm sorry. You wear your wedding. I do not wear my wedding ring. I've been married in March. It's going to be 23 years. You know,
tough.
You remember? You know how I remember that? Because I was married in the year 2000. So it's really easy. I mean, I can't screw that math up, right? All right, let's talk about it. Because, Guy, I feel like this is maybe something more for you and our friend Tim Seymour from the CNBC's Fast Money, because I wanted to be like the final countdown. Like this is what we got right in front of the CPI tomorrow morning, 8:30.
That's such a horrible. I mean, such an awful song. But you are correct, Dan, in your assessment. It's the final countdown, and we're going to talk about it with Dubs. But I think people are sort of gaming out their anticipatory belief that what's going to be the CPI number. I think a lot of people said, you know what? There was this run up last time. Let's game it out. Let's get involved now. And we can always pull a ripcord ahead of time. And I really think that's what we're seeing here over the last couple of days.
Yeah, and this is one of the reasons why we spend a lot of time on Market Call with the charts, and we are blessed with Carter's presence a couple times a week here because, there's a lot of charts that are starting to look a lot more constructive, and we're going to hit some of those, and you can see why when some people, you feel like we've been talking about this now. It feels like for weeks and weeks that a lot of the thought processes come along to our thinking, all right, where we think markets should be, what they should be valued at, given the rate environment, given what we think are the headwinds to growth and all that sort of stuff. But it seems like consensus now, right? And so we're here, 6 trading days, 7 trading days into the new year here. We have an S&P that's up nearly 3%. We have a NASDAQ that's up nearly 4%. It feels like people want to be bullish, to your point. And if we got a soft reading right on the consumer price index tomorrow, I mean, we know what happened when we got those November data. We had that big rip, but we did reverse. I want to kind of hit one major U.S. equity index. When I say major, it's majorly quoted, but I think at its all-time highs, okay, this is a Russell 2000, so this is small cap stocks, okay? Remember the market cap of the Russell 2000 was equal to that of Apple when it was like nearly a $2.5 trillion or something like that. But what's really interesting about this Russell chart, and we mentioned this back in October, it never made a new real low. I mean, it kind of had a match low from the summer, Guy. It's got the same downtrend that's been in place, right, over the last year, but this thing topped out well before the NASDAQ and the S&P 500 did. And it's above for the first time in a little bit here. It's 200-day moving average. So what is small caps in this relative outperformance off of those lows last year? What is that saying to you? Is it saying anything to you? Maybe is they underperformed in 2021 and they topped out, right? Does that mean anything to you?
I could take this one of two ways. This to me is one way to look at it. Is the market somehow believes that the economy is going to turn, small caps being the most economically sensitive names. They're trying to get ahead of something. I can't for the life of me believe that it's that. The flip side might be the fact that so many of the small caps don't have that international exposure that seemingly created some of the headwinds for some of the bigger multinationals. That might be what's going on. So I really can't have the answer. I'll say this, though. The environment that I think we're in and going to remain in does not lend itself to be bullish to the IWM or small cap stocks here, in my opinion. Yeah. So I look at this chart just to sort of go round turn here, and you've seen a trade through the 200-day a couple times, but each time it gets to this downtrend line, it's failed. And I think that's what we're going to see again. Now, Carter might have a different view here. Maybe those little double bottoms are more powerful than this downtrend line, but that's how I interpret it here, Dan.
Yeah, and if you want to look at it on a 5-year basis, I mean, when at its lows last year, it was down about 33%. I think, the S&P at its lows was down about 28%. We know the pandemic lows in the S&P were about 35%. I think it was kind of similar here. And, again, I mean, you see this thing, it was banging around the bottom, put in a little bit of a double bottom here, got above its 200-day. And here it is picking up its head again. It did do that a couple months ago, but we haven't talked about the Russell in a while. We haven't talked about small caps. I think the dollar coming in, I think that international exposure, all the things that you just mentioned, I think are really important, and they should be earlier cycle too, right? So that's why we want to keep an eye on.
Maybe we'll talk to EY from because she's sort of the small cap queen, if memory serves.
Yeah. So, Guy, in the tease on the tweet, I said there's hope for you yet, Russell. RTY.
Oh, I see what you did there. By the way, it's funny you mentioned.
You know what that's from?
No, it's probably like some Beastie Boys song. It's funny you mentioned Russell, and I'm completely off the rails here because prior to us coming on, somehow we got into a Ginger Marianne conversation.
Yes,
and, I actually said I was sort of a Mrs. Howell person, but you mentioned Russell. And of course, everybody on this feed knows that Russell Johnson played the professor. He also, by the way, was a fighter pilot in World War II. A lot of people don't know that. Quickly, Dan, Robert Byers, pull this tweet up. He says, apologies for being tardy. I would submit and I would retort, I don't feel tardy. And I know there are about 9 people out there that know what that is. That's, of course, a line from a Van Halen song. Back to you, Dan Nathan.
Yeah, real quickly, let's pull up the Matrix of Compassion. I love that. That handle is pretty good. He says, Dan, you've often played QQQs in the trading market. Are you playing them currently? I am not. I had a short position on last week. I got stopped out. I took it off. I'm really sitting on my hands here waiting a little bit. I did do that FXI trade that I detailed on Market Call, and I'm going to detail a trade that I did this morning in the GLD also. But we'll talk about that. I actually feel like, listen, if yields are coming in, I know that's what Carter's view is. I think that some of these kind of higher valuation names that have gotten cream last year, you're seeing some massive outperformance early this year that probably continues to go until we see either a hot CPI report tomorrow, right? Which would basically indicate the Fed is going to stay hawkish for longer. And then also we're going to get into earnings. I think they're going to be dreadful for most of those companies. So let's just look at the S&P real quickly here, Guy, because this is one we've talked about, the relative outperformance, the rotation into a lot of names that are not as heavily weighted as they are in the NASDAQ. We see how much further that is above its October lows versus the NASDAQ. We don't have that up here. But again, I think the last time we saw this index test that downtrend line and get above its 200-day was on that November CPI reading. If we do have a number, Guy, that comes in below expectations, okay, softer, are we likely to see a breakout above that downtrend, in your opinion, and will it be sustainable?
So I think consensus, and you probably have it at your fingertips, is like 6.3 or something like that. What is, is that?
Hold on, let me pull it up.
I think that's what we're looking at. As you look, I'll talk. But to your point, if we let's pretend that it is.
6.5 is the survey, and the prior reading in November was 7.1. So
7.165 now. All right. So I would say anything 6.3 or lower, I think the market takes off in a meaningful way, and we probably take a look again at that breakout and then subsequently failed breakout we saw a month or so ago. North of 6.5, I don't meaningfully north of 6.5, 6.7, 6.8. I think we're down 125 handles in the S&P. So problem is, of course, it's hard to game that out. I think you have to have a view going in. Here's my view. I think it's going to be hotter than people expect. I think for a lot of people, it seems to be a foregone conclusion that it continues to ratchet down in a meaningful way, which I agree with, but how meaningful it's going to be the tell tomorrow. And it's going to be obviously lower than 7.1, but I don't think it's going to come in south of 6.5. And if I'm wrong, we're here tomorrow at 1 o'clock and you guys can eviscerate me, but that's my thought going in, which lead me to believe you sort of fade this rally we're seeing today and maybe later this afternoon if it accelerates.
Yeah, the only one thing I'll just say is, and again, back to that prior question on the QQQ, I don't have any index in the S&P positions on right now, and I'll tell you why. I do think we could have an up or down 2% gap in either direction, and it feels like a bit of a coin flip. And so I'd rather play around the edges and some of the other things that I'm doing here. One of them is this, and we're going to bring Carter in 1 minute, but I just want to kind of detail this trade that I put on this morning. Guy, you and the gold, you made a very cogent case.
Me and the gold, I like that.
Long of the gold. Danny Moses, our co-host on the Tape podcast, is also bullish of gold. And Carter, I think it was on Monday, laid out the charts on gold and why he really likes the potential for a breakout. I think he was looking at it on a 20-year basis. Listen, I want to go the other way here. It just seems like, I know. And again, I want to kind of define my risk. I'm being a little bit cute here. This is my chart. This is the GLD. Carter may take some issue with it. Maybe that resistance is, maybe it's not real resistance. Maybe it is. I don't know. But you look at that steep uptrend. I just think that there's a good chance that no matter what happens tomorrow, you see gold break that uptrend, okay, to the downside. And then I'd be looking for a move back towards that 200-day moving average. Maybe that's 165, 166. So here is my trade in the GLD options today. When GLD was trading about 174.30, I bought the February 174, 164 put spread. I paid about $2.50 for that. I bought to open one of the Feb 174 puts for about $3. I sold one of the way downside 164 puts at about 50 cents. My premium outlay was $2.50. That is my max risk. I have profits of up to 750 between 171.5 and 164 with a max profit of 7.5 below 164, losses of up to 2.5 between 171.5 and 174 with a max loss above 174 of 2.5. Here's the deal. I am risking about 1.5% of the GLD. I have about 5 weeks for this to play out. My break even is down a little less than 2% with a max gain of about 4.5% of the ETF if the ETF is down 6%. So I really like the risk reward here. I'm not risking a whole heck of a lot. Options premiums are really reasonable, especially relative to a lot of other things that I think could move in and around this. And again, as always, I'm going to use a 50% mental stop here. So if this starts going against me, I am going to cut my loss of about $1.25 here. I do not like to see long premium directional trades go to zero. And when they start working against you and time is elapsing here, they will go to zero very quickly. So that's my trade, guy. It's not like an in your face. It's not an in Danny's face or Carter's. I like the risk reward here. What do you think?
In the face. That's Eddie Murphy, of course, coming to America. Great scene at Madison Square Garden. St. John's was playing a home game. Here's what I think. For you to be correct, or let's just put it this way. This position suggests that there's a chance, again, my opinion, that CPI comes in hotter than 6.5. Hotter than 6.5 keeps the Fed in play. Keeping the Fed in play has been bearish for gold. So it's almost as if this is sort of a synthetic put position in the S&P with probably a little more leverage. So I like what you're doing here because I just said 3 minutes ago that I thought it would come in hotter than expected. And if it is hotter than expected, I think this will fall into place for you nicely. Hopefully that was cogent. I tried to make it as possible. Thank you.
All right, let's bring him in. Carter.
There he is. Where is he?
Charting, Worth charting here. Carter.
He just threw that tie on. That tie is just thrown on. I can tell because his top button's not buttoned. There's no dimple, which is typically the case with CBW. Also, by the way, the slicked hair is just banging today.
I was running a little late today, and
it's all right. It's all good. Dan's drinking water. Everybody's relaxed.
Carter, 2 things before we get to my GLD trade idea here. You are not one of the sorts of guys who takes off your tie, like you leave it knotted and you hang it up. Guy, that's probably more you in a way. You know what I mean? But Carter, you take them off. You kind of probably have them pressed before you put them back on.
Ties can get in pretty bad shape, as we all know. They also seem to catch the spills.
Yes.
And I had one of my first bosses, he goes up, another man down, and he never bothered to send him the dry cleaner. Once a tie is stained, it's
gone. So, all right, Carter, you did a nice job laying out your kind of long-term take on gold. We were looking, I think, at the commodity. Now we're looking at the GLD, the ETF here. My quick technical take, any thoughts there if they could throw that chart back up? And again, I'm looking for a move back to that 200-day, maybe 165. This is not like a pound the table sort of thing. I just like the risk reward here. Thoughts on that?
Yeah, I mean, actually, I had a long conversation with a client today whose biggest positions are gold mining stocks, and the whole conversation was about selling calls. Now, a more plain vanilla strategy than what you're discussing, but it's someone whose view is long-term and very bullish. And yet we all can recognize it's come a long way. So tactically versus structurally. And I think that's what you're trying to do, right? It's a big move. Also, there's this. There are a lot of vacationers and day trippers. All of a sudden, you can see people who don't like gold, hated gold. Now they love it. It's making the news. And so usually when you see that, it's right to kind of take the road less traveled.
Guy, what do you think of that? Road less traveled. I mean, that seems
Well,
literally
he's
like a literary reference.
he's dropping a literary reference. He's also dropped a Beatles reference with the day tripper, by the way. I do think listen, we do call them tourists for a long time. Biotech attracted a lot of the tourists, people that didn't know a lot about the space, but were involved because the momentum was behind it. By the way, which is fine. There are participants in the market like everybody else. And I think Carter's right. The fact that everybody is seemingly talking about it lends one to believe maybe we'll exhaust ourselves here, and selling upside calls makes sense. I can't speak to the premium that you're getting paid, but I totally get it. I think fundamentally something has changed over the last year in terms of gold, and I think the trajectory is going to be lower left, upper right, with maybe some speed bumps along the way.
All right, so okay, and my trade is how about this? It's just a back and fill, guys. I can be right,
it's all
and you guys can be right. How's
that's
that?
what makes what do I say all the time?
It's all about your time frames, right? And you're trying to capture some money, make some money out of something that's probably going to back and fill for a bit.
All right, Carter, you heard us talking a little bit about what like some of the knee jerks might be to a CPI that comes in later than expected. We know that last month, again, we saw yields come in really hard. We saw stocks bounce, but then we saw that reverse. So you did some very nice work on your worthcharting.com. Nothing slick, just charts. And we just wanted to take the screenshots of those from, I think this email went out either, I think yesterday afternoon to subscribers here. Talk to us a little bit. You had the SHY, which I didn't even know this ETF existed, by the way. Guy, did you know this? SHY, it's a 1 to 3 year treasury bond ETF. And I'm
just hold on for a second. If you think about the name, it stands to reason that you didn't know it existed.
Okay.
Drop the mic. See what I mean? Shy, they're not out there like, yeah.
We have that. And so Carter, talk to us a little bit how you're thinking about these shorter dated treasuries versus the longer dated here, because again, what the Fed does and say with Fed funds, you're going to have this SHY more closely related to that, right? And then as it relates to the kind of longer dated, right? So we're going to use the TLT, which is the 20-year, but we're looking at the 10-year yield, and that's going to be maybe more reflective to growth. Which one at this point are you kind of a little bit more geeked up about, where you think there's a little more oomph in it if you do get that turn in yield?
Yeah, sure. I mean, just to start the conversation, if we have the TLT here, let's look at that and let's go back and forth, right? Let's do some toggling. Now, one could say, if you didn't know what it was, let's do it quickly, back and forth, back and forth, back and forth. If we can just toggle, you'd say, those are the same damn thing. And guess what? They are the same thing. And so, yet they aren't, because 10-year money is a lot different. The Fed has no control over the longer dated part of the curve, and they have all the control over the front. And so one would say, why would you make the bet that 2-year yields are going lower? Because this is price, right? So price up, why would you make the case that SHY and TLT are going up, which is you're making the case that yields are going lower? And while that might make sense, indeed, if we're getting layoffs and economic softness, that they're going to keep tightening, and therefore 2-year yields shouldn't move. Which is to say, if 2 yields don't move and 10 years do continue lower, then the 2-10 spread starts getting from negative 60, 70, where we are to maybe negative 100. But I don't think that's what's going to happen. I think both the short end and the long end of the curve are headed lower. And I'm basing that on one thing. Those patterns are identical.
That's interesting, Dan, because I agree, and I understand what he's saying. I'm still one of these people that believe 2s, 10s can invert to the tune of 1%. And, it could happen around 3.5, 4.5 type of thing. But, maybe it's different. Maybe it's 3.25, 4.25. But I'll say this, if that inversion gets back down below 50 basis points, you can also start hearing people talking about how, that headwind is now sort of abated a bit for equities, and maybe you're getting the green light. So a lot to unravel here. I'll say this, because if you look at that TLT chart, and for you bingo players, you really scored on the toggle and the back and forth. I've thought for a while TLT is going to go higher. Higher TLT means lower yields. And there've been a couple hiccups over the last few weeks, but this chart suggests the next leg is in fact higher, meaning yields go lower, Dan.
All right, so Guy, question for you, okay? Because you've had some really great yield calls, and I mean that sincerely. From the lows a year and a half ago, I think you were calling for 2%. We got there, then you made a 3% call. This is on the 10-year, and then we've basically been on the same side of this thing on the way down here. But you've been also kind of steadfast about what you think the 210 spread's going to be. At some point, will you kind of disconnect from your call on that in spread inversion and just focus on the broad, basically what might be the top end yield for this cycle, and then keep reloading as they kind of have fits and starts, one step forward, two steps back? Because one of the things, as your friend and as your co-host and as your kind of guy that we do CNBC together with,
my Sherpa,
I want you to be as right as you can be and not get stuck on a technicality in the 210.
No, fair. All fair? Good points. And I'm trying. Carter says it all the time. We all have biases. We all have our dogma. I totally get it. I fight against it as hard as I can, but we fall into the trap. Maybe I'm just so hell-bent on believing, almost by definition, we have to get there, based on two factors. The fact that the economy is slowing, which should push 10-year yields lower, but inflation is still a problem, which should mean that 2-year yields stay sticky, if not go higher. So that's where my head is at. Again, doesn't mean I'm going to be right, but that's sort of my thesis behind all this, Dan.
Yeah, fair enough. All right, let's look at some sectors in the market. We definitely want to look at some individual names here, Carter. Also, I just want to, you do a lot of great work, relative performance by different sectors, different major indices. I just wanted to get your thoughts if you're taking a look at what's going on in the XLV of late. That is the healthcare select spider, some of the big cap pharma names in there. I just put a little bit of overhead resistance. You see the double, as Guy likes to call it here. You see that 200-day a bit lower. Again, it looks like a big old consolidation, but some of the big names in the space that had broken out to new 52-week highs, and some of them were Guy's final calls for months on CNBC's Fast Money, they've come back pretty hard here. And I'm wondering, is this a reflection of investors kind of peeling out of some of the defensives? And then we have a 5-year chart too, which really shows a pretty wide consolidation over the last, call it, year and a half or so. Just thoughts on the XLV here.
Well, obviously it's heavily weighted towards big names. Of course, the two biggest are Johnson & Johnson, United Healthcare, and then you've got Pfizer, Lilly, Merck, and so forth. The real weakness in the sector has been managed care, right? You've got drops in Humana and Cigna and United Health that are substantial, 10, 12%. It remains my favorite single theme in the market by virtue of its defensive and offensive characteristics. And I like it especially as a pair, and we've looked at this together as a group, right? It's relative to XLP, to the big staples, Procter, Colgate, Coke.
Yeah, look, I mean, Carter's spot on here. The chart, you play the game again. If you didn't know what this was, what would you say? You'd say, look, we have stalled here, and we're probably going to do a back and fill, which is exactly what's happening. In terms of big cap pharma, Dan, real quick, I'll say, a lot of these stocks, for example, Merck went from $63, I think, in the fall, traded all the way to $115. I mean, that's a very significant move in a very large company in a short period of time. Eli Lilly's been a monster. Even Bristol Myers has shown some relative strength as well. Throw Amgen in there. There's a lot to like in big cap pharma. Gilead, which we probably don't talk about enough, has had a huge breakout to the upside for the first time in many years. So I happen still to think the space is in play. I think Carter would agree, but these things are trading vehicles as well, and there's definitely a bit of rotation. I just have to have one of the comments come on. Somebody said against. Is that a New York word? So here's the thing. How do you pronounce, and I want you all to play the game at home. How do you pronounce the word G-A-I-N? Of course, the answer to that is gain. So it stands to reason that you put an A in front of it and an S-T at the end of it, it would be against. And matrix of compassion, throw this one up. This is so good. One of the joys of watching Fast Money is to watch the innocent flirting between Michelle and Guy. Guy, how long have you two worked together? You have a good on it. If you had said it to her, that icy glare would have gone your way. Of course, would be Melissa. I've known her probably close to 18 years. And yes, we do have a lot of fun. Back to you, Dan.
That's really funny though, Guy, because we were on a couple weeks ago and we were all remote and she had a guest on that was named Michelle. And do you remember I texted you and her and I said, Mel, you should call her Melissa because she was Michelle. We have so many guests who come on and she'll ask him a question and they refer to her as Michelle. That's the joke there. All right, Carter, you just mentioned consumer staples, the XLP. Let's throw this up here because, you know, this is a sector that is deemed defensive, right? Because of the dividends and the nature of their products and the like here. But these names that make up Procter, Coke, you know, Pepsi, you guys know the names there. They're like trading 25 times earnings, you know, like mid single digits, you know, earnings and sales growth there. Thoughts here, because, you know, it feels like these have stalled out a little bit. You see, just I drew one line there. You know, they topped out, made new all-time highs at the height of fear in the early last year, right, during the invasion of Ukraine and stuff. Just so you'd much rather be long XLV and short this as a pair. Any thoughts on an outright basis though?
Outright basis, it's just exactly what a pair of twos is. Meaning, if you have a big moment, you bet big, right? If you have a big hand to bet big with, but three of a kind, flush, full house, what do you do with a pair of twos? You basically are, good technique is you lose your ante. You don't put good money after bad. You get away from it. There is no trade here. That's what a pair of twos is.
Guy, do you have a trade? You have a trade? You love it. Do you have a trade?
No, I think he happens to be I'm not parroting him, but I think he's right. You're sort of in no man's land here. I think the way to trade this is you get a break below the 200-day moving average. Maybe you'll start to accelerate to the downside and take advantage of that. Or you buy it on a breakout through that horizontal line that you drew, which has been resistance for quite some time. Otherwise, you're looking at a pair of twos. Now, if you're the big blind, you play the hand unless somebody basically, raises on the before the flop is the way I would play it, but nobody's going to do that because people are sheep. I would be one of these people though that would probably push some few chips in just to sort of test the waters, but that's just me. Back to you.
All right, we have 3 minutes left, and I have two topics I want to hit really quickly. And this is just kind of out of nowhere here because it kind of struck me as interesting that Starbucks today is kind of picking its head up. It's making a new 52-week high here. Carter, I'd love to get your technical take on this one. Again, I hate doing this to you when I do my charts because they're just not the way you would do them, but I'm using it as a context to kind of talk about it. And then I'd love to get your fundamental take, Guy, here, because this one's kind of surprising. You know, one of the things that I don't know if we don't have a longer term chart, but this stock was making new all-time highs in like mid 2021. Okay. And we were still in a rip roaring bull market and it topped out there. I mean, like literally topped out. It really underperformed many names in consumer discretionary for the balance of 2021. And then it was making new lows before a lot of its peers also. And here we are now, we're seeing some pretty dramatic outperformance.
Okay. Sorry. I'm up. Yes. Look, there are two circumstances in conflict here, and I think everyone knows what they are. This is impressive, right? This is a stock that bottoms in the spring, never gets back to new lows in October, whereas most stocks did. This is a stock who's not only month over month relative strength is good, so is its day-to-day relative strength. All of that notwithstanding, it's also back to a difficult level, right? You can see the overhead supply that looms back from exactly a year ago. And so this is where, in principle, I would be reducing, or, and this is the beauty of options, sometimes you can have your cake and eat it too. You sell calls and stay long.
Summer of 21, I think it was July of 21. If you put that chart, if you toggle back for the rest of you bingo players, that was the all-time high in the stock. I mean, it's been quite some time. Yes, we've had a meaningful bounce, but you know, if you sort of look at this, we're probably talking eyeballing it a little bit north of a 50% retracement off that all-time high and recent low. So it stands to reason, and throw valuation in there. Starbucks is not cheap, and it's not cheap in this environment specifically. I think you're looking to take profits here, Dan.
All right, last one here, Carter, because we're not going to get you tomorrow, but Friday morning we have, you know, massive bank earnings, JP, Bank of America, Wells Fargo, I think Citi also. And I just want to pull the BKX up here. You know, when you look at that ETF or that index, the KBW Bank Index here, I mean, you know, it's kind of like, you know, banging up against a level here. And before you hit that, I just want to like the Citigroup. I rarely say this, that the chart actually looks like it's trying to bottom here a little bit. It's touching its 200-day moving average for the first time in a year. And again, Citigroup is one of those names where expectations are not what they are at JP. If we fast forward here a little bit to the JP Morgan chart, we saw that performance off the October lows was double that of the S&P 500. Now it's breaking out a little bit. Thoughts on BKX or the banks in general, and if any of those that you'd lean towards one way or the other?
Right. So the BKX chart itself is we're getting into the pair of twos category as well. One thing that is important, if you were to juxtapose the BKX, which of course is dominated by Citi and Wells and Bank of America and JP and so forth, big U.S. banks are lagging European banks, and it's in principle are much worse as operating businesses. Deutsche Bank, Credit Suisse, Paribas, SocGen, and so forth. And so there was something we put out in the beginning of the week as a pairs trade, and there's an ETF for each, the KBWB for this. And it would make the case, and did make the case to be long that relative to the stocks 600 Euro Bank Index, and there's an ETF for that. In and of itself, I think you're likely to see this if one could know the future. The numbers, the results, whatever are good, they pop and they all fade. And they don't really do big gains. Or if they're bad, you just go straight down. I just don't think it's a great moment for getting long. And frankly, we're getting short. Yeah, it's sort of a no trade, the BKX itself.
What's amazing, Dan, is even when Carter's not on Fast Money, invariably his name comes up and we talk about how he's basically on the Parthenon, and people sort of love that, and I love what I get in return from that. But he's a freaking Mount Rushmore, man. Maybe by himself, Dan. I don't know your thoughts on that.
Well, that would just be a mountain with the picture of his face. Then no, we do quote him often, and we also quote him often on Market Call when he is not joining us. So Carter Braxton Worth, thank you so much. I'll just say this about the bank trades. I like the way he's thinking about it. I mean, I often like to get in front of events, and again, I know that can be a kind of risky proposition. I don't, for whatever reason, don't see the risk reward in tomorrow's in front of CPI, and then also banks. In some ways, I'd love for the banks to rally a bit more on mediocre sort of results. And then if our economic outlook kind of plays out, Guy, over the next, let's call it 3 to 6 months, those banks will be coming back because they will be feeling a little bit of those headwinds. And just some of the housing data and some of the stuff that we're hearing, we talked about what Wells Fargo is retrenching a little bit from the mortgage market. I just feel like the U.S. consumer really hasn't taken the sort of hit you might expect as far as the hangover from all of what we saw over the last 2.5 years. And I think that's coming to theater near you. I don't think it's going to be a wipeout, but I think the banks should probably start to reflect that, especially these large U.S. money centers.
I think Wipeout was a song by the Vapors, if I'm not mistaken, but nobody cares. As I mentioned, great win, but a lot of questions coming at me. People get mad at me because the thing scrolls too fast. Like, I'm not that bright. I got to do a slow scroll in order to read all the questions. But that's it for today. I want to thank Carter Braxton Worth, the slicked, I would say sloppily tie-adorned CBW, but it doesn't matter. Just nothing slick, just charts. No emojis with hearts, just charts. It ain't Rene Descartes, bitch. It's just charts. Of course, Dan Nathan, I want to thank our sponsor, FactSet, our data provider, FactSet. Now, listen, we're back tomorrow, and this thing could get off the rails tomorrow. EY from SoFi joining us as we've been sitting here. The market's accelerating to the upside, which is not a great setup into tomorrow, but that's what markets do, Dan. We'll talk tomorrow, 1 p.m. Eastern time.
All right. Thanks, Carter. Thanks, everyone.
Thanks, Carter.